December jobs numbers are, of course, in. 223,000 jobs were added. The unemployment rate ticked down to 3.5%. Our next guest says this continues to signal that recession fears are perhaps overdone. For more on this, eToro global market strategist Ben Laidler is joining us right now. Hi, Ben. It's good to see you. So does this mean the soft landing is indeed possible?
I think it does. This is really a sort of Goldilocks report. I mean, we've got enough of the sort of slowdown indicators to make us feel that, inflation is going to come down and the Fed can sort of back off. But, 220,000 jobs a month is completely inconsistent with a recession. And I guess we're seeing that in some other indicators as well. So, definitely, I think you're seeing some relief today. We've had some very strong other jobs numbers in the last few the ADP report and the JOLTS report, which I guess got people a little bit worried that maybe we were running a little bit too hot. And I think some of those concerns just got put to bed today.
If you're the Fed looking at this report, what do you think to yourself?
I don't think it really changes their trajectory too much. I think it's probably, what they're looking for. Again, I think similar to the rest of us, there's probably a little bit of relief, right? We've had a lot of volatility in this report over time. But I think as you look through it, whether it's the revisions to the last number, which came down, whether it's this number, which is, a pretty big, pretty chunky decline, whether it's the deceleration in the wage growth numbers. I mean, just take a step back. I mean, this is all about, inflation. Almost all the other inflation indicators are decisively turned down, whether it's, whether it's goods numbers, whether it's commodities, whether it's supply chains, even the sort of housing, the forward-looking housing indicators. The one that's missing is the labor market. So I think, and the fact that it's lagging is not a surprise. The fact that it's now moving, if but gradually, in the right direction, I think is a sigh of relief for the market, but also to your point, to the Fed.
Ben, we've seen markets really gain strength consistently today after this report. Do you fade this rally, though?
I think we're early in this sort of innings. I don't think the inflation story, I think that's got months to play out, but this is a good number. Again, it feeds into that broader inflation narrative, which I think is all moving in the direction. And we're pretty bullish on markets, right? I do think this sort of rates and inflation shock that you saw last year is absolutely going to fade. I think you're seeing a big recovery in China, which we don't talk about enough, but I think is a huge insurance policy against the global recession. And tech, which is by far the biggest sector in the market, I think is not going to lead up this year, but is going to have a less bad year this year than last year. And I think, given its size, is going to be very important of how this year plays out.
Yeah, we were actually discussing within tech some of the indicators to look for to really signal that the sector is ready for some type of bounce back. But one of the projections that we received yesterday was that we shouldn't look for that return in full force until the back half of 2024, which at that point would put us into an election year. And we know the tendency or the propensity for markets to kind of be sideways and just kind of flat, barely to the upside even in some of those general election years.
I think this is going to be a different year for tech. So last year was all about valuations being crushed and earnings being pretty resilient. I think this year is going to be about earnings, maybe not being crushed, but earnings certainly leading the market on the way down. And I think you're going to start seeing that in the fourth quarter numbers when we forget how cyclical some bits of tech are, and that, that $50,000 Tesla or that, $1,000 iPhone is ultimately a discretionary purchase, which many of us don't need to make. And I think that's going to continue to weigh. But I think the relief is going to come from valuations. You've had a complete turnaround in valuations in the last 12 months. And I think as we get to the top of this Fed cycle, as bond yields stay where they are or maybe come down a bit, I think that's where you're going to see the relief, which is the key ingredient, I think, to tech not having a repeat of its terrible 2022.
Terrible, but will it be down, Ben? Because if you indeed were recommending buying tech stocks right here, I won't say you're alone in the wilderness, but you don't have too many friends there with you.
Yeah, I mean, let's go now too ahead of our skis here, right? I do think the bottom for the market is in. I do think, call it the first quarter, where it's going to be choppy, right? This is this transition period as we get more visibility on inflation decisively coming down, especially those sticky bits of inflation and on top of the Fed cycle. So I think, that first quarter is going to have echoes of 2022, lots of volatility, two steps forward, one step back. So, keep it reasonably defensive. I think the things that worked in 2022 will continue to work in 2023. But the more we move further the more this market, I think, is going to de-risk, and you can take more risk. And that's tech, that's small cap, that's growth, essentially the things that just got absolutely crushed last year.
So does that mean energy still in 2023?
I think energy is going to be fine, but it's not going to lead, right? Commodities has been the big outperformer for the last 2 years. I don't think you're going to see that third year. I think this is a year when commodities takes a little bit more of a back seat. I think it's pretty well supported. I mean, the supply side is very, very tight. China's recovering, but I think demand overall will be lower this year than it was. Demand growth will be lower this year than it was last year. So I think commodities will be fine, but I don't think we're going to see a third year of leadership.
Ben Laidler, eToro, global market strategist. Good to see you. Have a good weekend.